Hello and good morning friends, welcome to CEC EduSet live lecture. Again with our previous lecture, that is on preparation and analysis of financial statements. We are again here with you, and in our previous lectures we tried to make you learn about the preparation of the financial statements. Yesterday we talked about the analysis portion of the financial statement. Again we are going to continue with this very topic as it is a very wide topic and you are going to learn more about it. Yesterday we try to give you a deep insight into the comparative analysis, horizontal analysis, and then we left with ratio analysis. Although the time left with us yesterday was very less, so we have decided to continue with this very subtopic, that is ratio analysis, which in itself is a very huge and a wide topic. For this we have again with us in our studio Dr. Amarjeet Malhotra, who is professor and associate dean in one of the leading universities. So I would like to welcome our guest Dr. Amarjeet Malhotra. Welcome to this EduSet lecture of ours, ma'am. And as we left with the ratio analysis, I try and I request you to please continue with this topic so that the students who have want to know more about it would be able to recall it through this lecture.
Sure. Thank you very much. Very good morning to you all. We will start with the topic which we were talking last day, that is ratio analysis. Though I was able to give you just a brief outline what does a ratio stands for. So ratio, as we talked, is a relationship between two variables, and we can express this relationship whether in pure form, in times form, in percentage form. And as we talked, this is the most commonly used tool of analysis of financial statement. So just to begin from the point where we stopped last day, we're talking about importance of ratio analysis. We talked that, just to recall, we talked about that ratio analysis can be used for knowing the position of liquidity for a company, to know the financial solvency of the company in long run, to know the operating efficiency of any business, and then finally to know the profitability. So these were the points which we talked under the importance of ratio analysis, and I believe you all could understand those points. Now we will take it further. Though I said that ratio analysis is very important tool and most widely used tool, so it doesn't mean it doesn't have any limitation. It does have a few limitations as well. So ratio ignores qualitative factors. This is the first important limitation, that we do not consider any qualitative aspect while calculating ratios or while using the ratio analysis. It means we will consider only and only quantitative factors. There could be something very important which has happened for any business, but still it has not been considered while calculating ratios. So this becomes in itself a very very damaging limitation for ratio analysis. It means person has to, whosoever is carrying the analysis, has to understand other factors into consideration while carrying this ratio analysis. The second limitation is this, that these are trends and not the actual ratios which are useful. If you remember last day, we talked about trend analysis as well. What will happen in ratio analysis? We will get only one ratio for two variables. We may establish relationship between two variables. Of course, ratios are far better than independent variables, right? That's what we talked about. Basically, analysis in itself establishes a relationship, whereas variables are independent. We cannot study them in isolation. They do not carry any meaning, any weightage as such for decision making. So ratios, as I said, as we discussed, that they are described pertaining to two factors or two variables. So and if we go further, ratio will give us value for two variables, relationship between two variables. Now I am saying ratio in itself are not that much important if we don't use trends. So what is trend then? Trend analysis means we are describing ratios for more than 1 year at least, 2, 3, 4, 5, 10 years. So if we will use trend analysis, which has definitely the ratio part in it, so which, if you remember the formula last day we discussed, trend analysis have the ratio in it. So this is the trend analysis which is more useful than ratio analysis. But without ratio analysis, we cannot have trend analysis. So it means ratios are definitely important, but they become more important, more useful if we use them with trends. Now after this, the next limitation is the limitation of accounting information itself. You know, accounting information is generated by complying to certain guidelines, by complying to, you know, directives given by certain accounting bodies. So if accounting information is incorrect, you know, if you remember the case of Satyam in India, Enron in US and many more such cases, you know, the accounting information was cooked up. That was not a real information. So whatever the conclusion you may draw based on that information, your conclusion, your ratios are going to be incorrect. So accounting information, if is not correct, is not fair, is not true, that is a limitation. So that's the point I am bringing out. So while using ratio analysis, you cannot depend it solely simply knowing that I am using ratio analysis. This is the most important tool, and hence my conclusions are dependable. So that's the point I am saying. No, we cannot say that. We have to have this fact in our mind, that whether the information which is given in balance sheet and income statement, which is actually the basis for our ratio analysis, is true or not, right? So we have to give a very deep concern and conscious consideration to the fact that information should be correct, it should be true, it should be fair, it should be complete as well, right? You may be remembering the case of Satyam. It has happened just recent years only. So we all know the data was incorrect, data was cooked up. We call it as creative accounting. And that was basically a cooked up data. So no conclusion whosoever, whether a very senior analyst was carrying the analysis, or many a person with strong academic backgrounds would have been carrying the analysis, the results would be incorrect in such case. So that is a limitation. Then the next limitation is change in accounting procedure. If any company changes accounting practice, any accounting procedure on year basis, or even from the last year to this year, the accounting information is going to be different, is going to be somehow inconsistent, and the ratios are going to be somehow not reliable if you are using it as it is without considering the fact that some accounting procedure has been changed. So the point here is to know that we should have the capacity to understand whether any accounting procedure, practice has been changed or not. For example, if had I been using a straight line method for valuation of my depreciation, and now I want to switch to some other method, so definitely my profit figure or my loss figure is going to vary from previous year. So while using the ratio analysis, we need to take care of we need to reduce or abolish the effect of such changes in accounting procedure. Only then our results would be reliable, our analysis would be more reliable. So basically adjustments need to be made while carrying the analysis for any such accounting change, accounting practice change, right? Now the next point, which is another limitation, is variation in general operating conditions. It happens that sudden changes happen in the general business operation conditions of a country, of a particular industry, of particular zone, etc. So we cannot ignore that. If you remember, yesterday only we were talking about the example of Japan. Tsunami happened there, and suddenly the conditions changed. There was advisory by federal government that you should not be buying a farm produce which has been produced in that particular region. What does it mean? It means that because of that condition which has changed, your results are going to vary. So we cannot say there is a steep downfall in the sales of a particular company who was operating in that particular region, simply because that was an abnormal year, abnormal conditions were there. So in case general operating conditions may occur, and it could be vice versa. There could be some sudden government policy where government announces to buy certain particular product product from a particular region of the country. Here I am talking about geographical location, right? So the sales of those companies who are operating in that particular economic zone may go up, may shoot up in that year. So we cannot say that, we cannot give the complete benefit of this particular conditional change to the operations, to the efficiency of the company, right? So we, while using ratio analysis, we need to consider this fact as well. Now after this, the next point is ratios could be sometime misleading. What does it mean? Misleading, say for example, the sales of X company, let's assume there are two companies, X and Y. The sales, and they both are dealing in cars, they are car manufacturers. X companies, XYZ, any model, their sales were 5,000 units in last year, and this current year the sales have gone up to 10,000, right? So how much increase is there? 100%. 5,000 to 10,000 units, it means 100% increase is there, right? Now there is another company who was selling 20,000 units, right? And this time they could sell 30,000 units. So if we will, so how much increase is there? 50%. So 20 to 30. Now if we will use ratio analysis here, we will say as a percentage the company, the first company is doing better than the second one because their sales have shoot up by 100%, whereas the second company, their sales have gone up by 50%. But if the fact of the matter is this, the first, in absolute numbers, first company could increase or could sell 5,000 more units, whereas the second company could sell 10,000 additional units, right? So definitely the sales in difference between the two, the increase of absolute number between two companies is double, right? So we, in this case, the results based on the ratios would be misleading. So you should have that much understanding while using ratio analysis that it could be for times misleading. So we need to be having fair understanding about absolute values, about pure or ratio expressions as well along with ratios. Now after this, ratios have another limitation which actually almost every tool has, that it doesn't consider the price level changes, it doesn't consider the inflation. So your profits may be shooting up on year basis, but the point is whether that increase in profits from the last year is more than the inflation rate of the country or not. So that is not been considered. Whatever the values we do show in our calculation while using ratio analysis, we do not adjust our values for price level changes, for inflation. So that becomes a limitation here, right? So the last limitation is limitation of standards to compare. Ratios are just values. They are nothing but one value. They are just they are not the end thing. We are using them as a means only to draw some conclusion. So we should have some kind of yardsticks to compare the calculations, to compare the values. So the point I am making out here is this, that ratios do not have rules of thumb or standards for every ratio. We do have, in analysis, we do have certain rules of thumb, but only for selected ratios, which I shall be addressing after a few minutes from now. But every ratio has not its rules been defined in the literature, so that becomes a limitation. So it means it will depend upon the person, the knowledge of the person, the experience of the person, whosoever is using this ratio analysis to draw a best conclusion out of it. If somebody who is using it and is not having a vast experience or in-depth experience about the ratio analysis and other factors as well, because it's not only the ratio analysis which is useful, it is more than that. You need to have the understanding about the economic condition or the general condition, political conditions even. Today we are expecting the results for the elections after 2-3 days, and we have many pre results announcements on the TV screens from since morning. I've been listening to it, And because of those announcements or those assumption or those opinion polls and all, the share market is already going to react. There's kind of shaking news into the share market. So such knowledge, such information which is going to affect the business results, business conditions, are important for everybody to know. So if I am using ratio analysis, I need to know that a particular industry and the companies in that industry may have some positive or may have some negative effect because of political change in any country for that matter. Though by chance today is 13th May and we have results expected on 16th May. So is true for every country, so is true for every place. That's the point I'm making out, just giving you a live example here. Now after this, I would like to talk about classification of ratios. As we said, ratios are something which is most commonly used tool for analyzing financial statements, and based on the functions we can divide ratios into 4 categories. One is ratios which define the liquidity of the company, liquid position of the company. So we call them as liquidity ratios. Second set of ratios are known as solvency ratios. Third set of ratios are known as profitability ratios. And the last category of ratios is known as activity ratios, and they are used to find out how efficiently business operations have been carried during any financial year. So these are the classes. Now, since this is a very practical topic, I cannot keep just talk about theory as far as theoretical aspect or aspects are concerned or concepts are concerned. I've already addressed them. Now I would like to address all the ratios under these 4 categories, under these 4 classes, but with the help of one case. So I'm going to use here a case of Norton Corporation. I am going to take data financial statement for 2006 and 2007 for 2 years, and this is a corporation, Norton Corporation, based in US. So we have balance sheet. This particular slide is showing you the assets value for 2 years, 2006 and 2007. You have in the current assets, which has cash, accounts receivables, inventory, prepaid expenses, total current assets, and then we have property and equipment, we have land, building, and we have total value of equipments, and the total assets comprising current assets and fixed assets is $3,46,390 for 2007 and $300,000 for 2006, which we may call as 3 lakhs for 2006. Right. So these are assets for Norton Corporation, and we have also been here given the liabilities for the company. We have total current assets which is current liabilities, which is $1,12,000 for 2007 and $1,20,000 for 2006, and the total liabilities and stock definitely would be equivalent as was in the previous slide, which is 3,46,390,000 for 2007 and 3 lakhs or 300,000 for 2006. So this is the balance sheet, both assets and liability side. And now we have the income statement as well for the company. This is horizontal presentation. I hope you would be knowing horizontal and vertical presentation. So this is vertical as well as horizontal. We have data for 2006 and 2007, but as far as figures are concerned, they are expressed in vertical format. They are not in T shape. So net sales, cost of goods sold, gross margin, operating expenses, net operating income is there, interest expenses are there, net income before taxes is given, and then we have been given taxes as well at the rate of 30%, and finally we have the net income for the company. Now let's see, we want to use this data of the Norton Corporation to find out well-being of the common stockholder, that is equity shareholders. It means if I want to find out that how well equity shareholder, that is common stockholders, are placed, or how good this company is for them, we will be using certain ratios. So the first ratio we shall be using is earning per share. Earning per share defines that how much earnings one share is been getting after investing in this particular company. So how can we calculate this earning per share? We can calculate earning per share by dividing net income which is available to shareholders. Now question is which income is available to shareholders, which are equity shareholders here. Income after paying the interest, income after paying the taxes, and income after paying the dividend to preference shareholders is the income available to equity shareholders, right. So that is the numerator here, and we will be dividing it with the average number of common shares outstanding. So why our average number? Whenever we use two values, two factors, one from income statement and another from balance sheet, we use average value. We do not use the only end value or the closing value. So average value is going to be taken, that means opening value or opening number of equity shareholders plus the ending number of equity shareholders divided by 2 will give you the average value, right. So now this measure, this particular ratio indicates that how much income was earned for each share of the common stock outstanding for the company. So basically this is a ratio which helps the to know the status of the earnings for equity shareholders. So how well company is doing is going to be known, and this is precisely for equity shareholders. For Norton Corporation, it is coming out to rupees $2.42. With the help of given values, I don't think it is possible for you to remember or memorize those values, but what is important is the discussion and the conclusion and the interpretation of these ratios. So basically this is a primary ratio to find out how well or how good a company is for equity shareholders. Now the next ratio I should be recommending that when we want to see how good a company is for equity shareholder is the price earning ratio. Now the price earning ratio can be calculated by dividing the market price per share with earning per share. So this ratio gives us the relationship between two variables, that is what is the price of the share which is in the market and how much company is earning, that is per share. So this measure is often used by investor as a general guideline to gauge what? To gauge the stock value. Generally the higher the price earning ratio, the more opportunity company has. It is assumed that companies who are doing very well, who have growth prospects, basically there are three types of companies considered in finance, in the literature of finance. Companies which are growing, we call them as growth firms. Companies which are just indifferent to any opportunity, they are neither growing, they are not declining, so we call them neutral firms or indifferent. And finally we have third category which are the ones who are at a declining stage. Their business are declining, their growth is not there at all, and they are at the verge of closing, or they are in a process of declining. So there are three categories of companies as far as financial decisions are concerned. So it has been assumed that firms which have growth prospects, which have opportunities, which are working in a particular sector which is growing very rapidly or is going to grow in future years, those companies have their market price of the share is high, their earnings are accordingly linked with the market price. So this particular ratio which we are talking here is going to show that whether a company has a growth prospect or not, or in fact it's not the actual position, it is actually how a company is being perceived by the shareholders, current as well as perspective in the market. So this is basically a message about the growth prospects of the company. If company has higher growth prospects, good opportunities available in that particular sector where the company is working, then this ratio is going to give a positive impact or positive message about the company. So for this company Norton Corporation, this value is coming out 8.26 times, right. The third ratio, which is again useful for knowing the condition or the position of shareholders, equity shareholder here, is dividend payout ratio. So dividend payout ratio defines that out of the earnings per share, whatever I am earning, you know, how much I am paying. So I would like to explain here that it's not that whatever a company is earning is going to pay 100% to its shareholders. There are certain legal obligation. Apart from legal obligation, companies prefer to, you know, retain certain amount out of the earnings available to equity shareholders. So we call them as retained earnings. It means whatever is retained, remaining amount is been after retention, the remaining amount is paid as dividend to equity shareholders. So this ratio, which is dividend payout ratio, basically defines how much is being paid out of earnings available to equity shareholders. So the difference of this ratio from 100 is the retention. So that is also known as retention ratio. So basically the companies which have higher growth prospects, they do not pay high. They prefer to retain because they have opportunities to reinvest. They have higher growth prospects. They may not, and it is been expected that shareholders don't mind if their earnings are retained by the company, if they are not paid out as dividend, provided companies have growth prospects, provided it has been expected that company is working in a particular sector where there is a possibility of growth, that particular economic sector is growing. So if that expectation is there, that perception is there in the market, your shareholders don't mind companies to retain the earnings, though that earnings belongs to them. If they are retained, even then the retained money is something which belongs to shareholders, right? So that's the point I am making out. So the next thing, next ratio which I would like to talk about is dividend yield ratio. Now this dividend yield ratio is something which defines dividend per share and the market price per share. So the relationship between how much is being paid to shareholders and market price per share. So this is something, a very critical, you know, analysis of market price of the share. This ratio identifies the return in terms of cash dividends on the current market price of the stock. So this is an extreme analysis of, you know, how a company is being perceived from dividend payout ratio, from the perspective of dividend payouts, and the perception will define the market price of the share. So these were the ratios which are used for defining the the shareholders status or company status from the shareholders perspective. For this Norton Corporation, dividend yield ratio is coming out 10%. Now after this, I would like to talk about ratios which are going to be used for assessing how efficiently resources have been used. And the first one is here, return on total assets. Return on total assets, it measures how well assets have been employed. So efficiency of utilization of assets, fixed assets especially, is being talked here. So what do we do here? We take net income plus interest expenses. We may deduct tax charges out of it, but in few books you may not find this adjustment. But at very senior levels, we recommend that we should be adjusting tax rate out of the interest expenses, because interest is a tax deductible item. So we should be deducting the tax amount which we have actually saved because of this interest expenses out of the interest, and then it should be added to net income. So net income plus interest expenses after tax adjustments is divided by average total assets. Since income is a item from income statement and assets are the items from balance sheet. So as I earlier said, if we are using two variables, one from income statement and another from balance sheet, in that case we generally use denominator on an average value. That is a practice in accounting word. So you should be remembering this as a simple rule, that when we are selecting two variable, because this is known to you I believe by this time, that ratios are definitely relationship between two variables. So those two variables may come from only income statement, may come only from balance sheet, or one item, that is one variable, may come from income statement and the other variable may come from balance sheet. So in this particular ratio which we are just talking about is that we are having one item or one variable from income statement and another variable from balance sheet. So return on total assets is a very important ratio to find out how efficiently the assets have been utilized. Now the question is, do we have any rule of thumb here? We do not have any rule of thumb here as far as this ratio is concerned. This value, the standard value, vary from industry to industry. There are certain industries, sectors of the industries where these values are expected to be very high. There are certain certain industries where this value is very low in the beginning, and later on in later years this value is expected to be very high. For example, power generation. In the beginning, the investment in fixed assets is huge. We call that as gestation period or gestation period. So in that gestation period, we do not get any return because we are just investing in fixed assets, and that is too very hugely. So we hardly get any return on that. So in that case, in that particular sector, in power sector, this ratio that is return on total assets will be very low in the beginning years and will be very high in later years. So we cannot ignore. That's why I just said that this is something important, that we should have understanding about the general operating condition. If I am using ratio analysis, I should have understanding that for which particular company I am using this analysis, which particular sector that company is working in, is been there, because that is something important. We cannot have a similar result expected for all the companies in different, working in different sectors. So that sectoral understanding, that general condition, that political conditions, that all should be known to an analyst who is using this ratio analysis. That's the point here. So if we talk about rule of thumb, there is no rule of thumb, but higher it is, better it is for any company, right? Whenever you are using it, the higher values are always recommended, are always desirable. Now for this particular company, for Norton Corporation, this value is coming out 18.19%, which is not very bad at all, which is just okay, that we are getting 18% return on all the assets which company has employed. So that is the conclusion here. Now the next ratio which I would like to use for Norton Corporation to know the stockholders status here: return on common stockholders equity, return on shareholders fund. There are many names to this ratio. So in a foreign author's book, you will find return on common stockholders equity or return on equity shareholders fund. And this ratio can be calculated by dividing the net income after paying dividend to preference shareholders with average stockholders equity. So as I said, again the average word is marked here in red. So again I am emphasizing the point, since numerator is from income statement and denominator is from balance sheet, so that is why we are averaging the stockholders equity. But you may not find that in examination problems you are able to find out the average value of stockholders equity, or even for total assets, which we just talked in the last ratio. So in case it is possible, in case you have been values for 2 years, that is opening and closing value, then definitely we will recommend you to use average of the value. If not, then definitely you have no choice than to use only the closing value. So in this case, we will be referring to the income which is available to shareholders, and as you know, equity shareholders are being paid only after interest is being paid, only after taxes are paid, and only after preference dividend is paid. So every company, of course, do not use, each company doesn't use your preference share capital, but companies who are using this preference share capital should be paying off their preference dividend first, and whatever is available is available for equity shareholders. So that is the income I am talking about here. It is going to be divided by equity shareholders fund, average stockholders. So shareholders fund may comprise the value of the share capital plus any retained earnings from the past years plus any premium on issue of shareholders. So this averaged value of equity shareholders fund is the denominator here, and this ratio for Norton Corporation is 25.9%. So higher it is, the better it is for the company. Again, there is no rule of thumb for this particular ratio. Now, based upon this ratio we just talked about, we have one term which is very closely linked to this ratio, which is known as financial leverage. So financial leverage involves acquiring assets with fund at fixed rate of interest. What does it mean? Leverage is basically existence of something which has some fixed interest bearing. What is that? Debentures are having something which has fixed financial charge. We have to pay the interest charges on debentures. There is an obligation, there is a legal obligation to pay interest on debentures. If we are using bank loan for long term, if we are using term loan, even they have interest charges payment applicable on them. So they all are known as funds having fixed rate of interest on them or having fixed financial charges. So this is an obligation for the company to pay that fixed financial charge on year basis up to the maturity of the principal amount. Now what happens, it is assumed that funds which has fixed rate of interest, they are assumed to be having a lower rate of cost than the funds which are not having the fixed rate of interest, because investors who have invested in debentures or who have given the loan, they are kind of sure about their returns. So their risk is less, that is why they are expecting less return. So though it means debentures, preference shares, bank loan, etc. are a cheaper cost of finance available to companies than equity shareholders. So if company is using this particular sources of finances, their financial leverage is being used. It is been said that companies are using financial leverage, and the moment we are using financial leverage and we are earning higher on our assets than whatever we are paying on fixed interest bearing securities, that is debentures, loan, etc. So we are actually earning something beyond that, and this is available to this excess of payment of interest charges, then to your returns on assets is difference which has been paid, which has been available to equity shareholders. So basically equity shareholders are enjoying higher rate of return to their shares because of existence of these debentures in the funds, in the finances of the company, in the capital structure of the company. So that's the point I am making out. So if your return on investment is return on asset is higher than whatever we are paying on the borrowed funds, we call it as positive financial leverage. Just refer to the arrows indicating here, right? And if return on investment in assets is less than the fixed rate of return on borrowed funds, so whatever you are paying as interest charges is more, it means your returns are less, you are paying more, then we will call it as negative financial leverage. So leverage is a situation where we have funds which are having fixed rate of interest or fixed financial charges in form of preference dividend as well. So there is a strong linkage between leverage and the trading on equity. We call it as trading on equity as well. So basically trading on equity is a situation where equity shareholders are enjoying something beyond what they are actually earning on their funds. This is something which has been earned on debenture holders fund and is going to equity shareholders. So we call it as trading on equity. Now, after that, I would like to talk about another ratio which is known as book value per share. So, here the common stakeholders equity or the value of equity shareholders fund is divided by number of common shares outstanding for the company. So, this ratio measures the amount that would be distributed to holders of each share of common stock if all assets were sold at their balance sheet carrying amount and if all creditors were paid off. So, book value per share is not very commonly used or ratio, but still I've been talking about this because this is something which may be used in examination problems. For Norton Corporation, the value is coming out $8.55 per share. Now, let's talk about certain ratios which are being useful for short-term creditors. So, we will be using the data of Norton Corporation. On the right hand side, you have the data, and we are going to use certain ratios which are going to be useful for short-term creditors. Basically, I am referring to liquidity ratios here. So, the set of ratios now we are going to talk about are the liquidity ratios. So, just to talk, working capital is the difference between current assets and current liabilities. That is what is also known as net working capital, and I believe you know that. So, by using this current assets and current liabilities as two variables, we can use it to define the ratio known as current ratio. So, current ratio is basically something which establishes the relationship between current assets and current liabilities, and this is a ratio which is known which is used to know the liquid condition, liquid position of the company, right. So, how well a company is to pay its short-term liabilities, to short-term obligation is going to be worked out by current ratio. So, this ratio has, as I said while talking about the limitation of the ratios, I said every ratio doesn't have its rule of thumb, but this current ratio has its rule of thumb, its yardstick, which is assumed, which is expected to be 2:1, which means the current assets should be 2 times then the current obligation, then the current liabilities. The current assets includes cash, your bank balance, your bills receivables, the value of debtors, anything which has been paid in advance, that all are current assets. We will divide the total of these values by the current liabilities, which is bills payable, your creditors, your short term payments, etc. due, right. So, they all are your current liabilities. So, it has been expected that your current assets should be twice as much as twice than as your liabilities. So, minimum of twice, but it's not a complete feedback or information, a piece of information. We have to have a look of the amount of stock in the total assets. Company may be showing a very good more than two times current assets than liabilities, but we have to further analyze how much is the value of stock, that is inventory in the total current assets, because higher the current value of inventory, higher is the risk for the company, and this risk becomes more riskier, more damaging if the stock is not moving. So, one thing is how much value of stock is there in total assets, current assets, and second is this, out of the stock, how many type of stocks are not moving at all or are moving at a very slow pace. So, we call them as slow moving stock or no moving stock. So, basically I am talking about the quality of inventory here. So, company may have a good amount of stock inventory and may have more than twice of current assets than liabilities, but even then company may not be in a good current condition because the stock is not moving, and this particular thing need to be considered in mind when we are talking about those companies who are dealing in those products which are tech savvy or technological based. For example, the companies who are dealing in mobile handsets, companies which are dealing in laptops, in PCs, etc. They are on high risk that they have stock which is not moving or slow moving. The moment a new model is being launched in phone, in laptop, in PCs, etc., the previous models, their demands goes drastically down, and So companies may show that they have current asset because stock is a current asset, but actually the company is not in a very good liquid condition, because until unless we sell the stock off, we cannot convert that stock into cash. So it's important that the stock has been sold and then the sales are on cash, or if they are on credit then they are being collected. So it's also important that credit sales are being collected. Only then we can have, we will say that there is a cash out of the sales. So for Norton Corporation, this current ratio is 1.55, which is not bad at all. It is near to 2, but we should be considering the value of stock in the total current assets. Now, for Norton Corporation, the current assets include cash, marketable securities, accounts receivable, and current notes receivable. So it doesn't carry the stock, which is something very, very good. Now, the next ratio which is used to know about how efficiently business have been carried, and can also be used to see that how well a company is, or how good position a company is to pay or to deal with its current assets and current liabilities. So now ratio is known as accounts receivable turnover ratio, or debtors turnover ratio. This ratio is calculated by dividing the sales on account with average accounts receivable. So sales on account means sales on credit. That is how we call it as sales on account. You may call it as credit sales. This is going to be divided by accounts receivable, but value is average. So average accounts receivable means opening value of bills receivables, your debtors plus closing value of debtors and bill receivables divided by 2, that is what is going to give you the value of average accounts receivables. So for this Norton Corporation, it is 20. We express it in times form. So it is 27 times for the company. This is not bad at all. It means ratio measures that how many times a company converts receivable into cash. So it means company is converting, this Norton Corporation is converting its sales in 27 times into cash. So which is very, very good actually. Now if we will divide 365 days or 52 weeks or 7 days, or even any measure by this ratio, that is accounts receivable turnover ratio, we will get average collection period, which will give you an idea that how many days a company takes to collect from its to collect accounts. So this is a very good ratio, and for Norton Corporation it is coming out 13.5 days. It means company is selling on credit and is being able to collect the credit sales within 13.5 days only, which is not bad. So this can be expressed in weeks, in months. If we will divide 12 by this ratio, we will get the answer in months. If we will divide 52 by this ratio, then we will get the answer in weeks. And here in this particular ratio, we have divided 365 days and we are getting the answer in days. So you have the option to get the answer in any form, whether days, months, or your weeks. Now the next ratio is inventory turnover ratio. This inventory turnover ratio can be calculated by dividing the cost of goods sold with average inventory. This ratio gives you the value of how easily a company's inventory is being converted into sales, or is converted. The ratio measures how many times basically a company's inventory has been sold and has been replaced during a year. So this ratio can, as I said, is calculated by dividing the cost of goods sold with average inventory, and is coming out 12.73 times for the company, for Norton Corporation, the case we are talking here. So which is not bad at all. So the higher it is, better it is. There is no rule of thumb, as I said. In such cases, we generally take the industry average time. So this particular ratio, we do not have any rule of thumb individual. But for the company, if we want to see whether the company is doing well or not, or good or not, we should be referring to the industry average of inventory turnover, right? So this particular ratio is also known as turnover ratio, the part of turnover ratios, part of activity ratio. If you remember, I talked about 4 categories. So this is under the activity category, or also known in few books you may find the word turnover turnover ratios. So here I'm been using the word turnover, right? The next ratio is average sales period. If we will divide 365 days, 52 weeks or 12 months by this previous ratio, which was inventory turnover ratio, we will get how many days it takes to convert the inventory into sales. So average sales period, this ratio measure how many days on an average it takes to sell the inventory. So how many days our inventory takes that our inventory moves out of our godown. If you remember, we produce, if you understand, I believe you understand that we produce, and generally most of the companies they store it. If it is a manufacturing company, they store it in the godown, in the warehouse. So this ratio is calculating basically that after production is over, the production cycle is completed, how many days it takes for the company to move the stock from the warehouse to the market, right? So the lesser days it is, better it is for the company. So it is 28 days for this Norton Corporation. So we cannot comment very fairly here until unless we know the nature of the business of Norton Corporation. We need to know which particular industry this company is working in, this company is placed. You know, that is important. So as I said, for certain ratios we do have standards, but but not for all. We do not have standards for all ratios. So this 28.67 days could be fine if this company is, you know, in a particular industry which deals with products like TV, like products like air conditioners, like microwaves, etc., etc. These days should be less for the companies. For example, if company is dealing with soaps, toothpaste, their number of days should be less for sure. This could be more higher for a company who is dealing for example, you know, aircrafts, etc., maybe buildings, etc. They need more days to, you know, move their stock out of their store. So now we should be using the ratios to find out the long term or the effect of, you know, financial status on long term creditors, or how we can assess that a company is good for a long term creditor or not. For that purpose we will be using certain ratios. First of all, we shall be talking about times interest earned ratio. So it is also known as interest coverage ratio. In Indian books you will find it has been known as interest coverage ratio. This can be calculated by dividing the earning before interest expenses plus income taxes by interest expenses, right? How many times my profits are there to pay off my, you know, interest charges, that is what is been calculated here. So the higher it is, better it is for the company.
Sorry to interrupt you, ma'am. There is a caller right from Mumbai. I think we should take this call. Hello.
Hello, I am Sudhir calling from Mumbai.
Yes, Sudhir, please ask your question.
Yeah, there are some advertisement coming at the bottom of the screen that is blocking your view.
Locking. Okay, we wish you to please ask your question regarding the subject.
I understand. What you can do is that slightly you move the slide up.
You want the slide up? I thought you must have any questions regarding this very topic. Dear friend, if you have a topic, concern topic, if you have question regarding that, it would be a pleasure, and your suggestions would be soon will be incorporated. Do you have any question regarding this topic? Sometimes we get callers like this, but it is good that our callers are, the people are watching us and giving us instant feedback. It would be better if you would please ask questions regarding this very topic. Yes, ma'am.
This established the fact that, you know, he was very, very keen in listening to the topic, and he was very careful, and he wanted that the complete slide should be visible. So I appreciate that, though he couldn't ask any question, but never mind. I hope we will have, you know, questions in next few minutes. So the ratio which I was talking about was price, you know, times earned ratio. How many times our profits are higher than our interest charges? That is what is being established by this ratio. It means companies which have financial obligation in terms of interest to be paid, in terms of dividend on preference shares to be paid, our profit should be many times higher. Again, this particular ratio doesn't have any rule of thumb. We again have to see to the industry, yardstick, industry's averages here, and will then be able to find out the how well a company is doing. So
Sorry to interrupt you again, ma'am. There's another caller waiting for us.
Okay.
I think
Okay.
the caller is from Tamil Nadu. Hello?
Hello.
Yes, please ask a question.
Yes, my question is.
Please speak loudly. We can't hear you.
Yes, my question is. Ma'am, she
Please,
is
please,
talking
please,
about
please,
the topic.
please repeat once again and please talk loudly. Yes.
Ma'am, can I speak with madam?
Yeah,
yeah,
sure.
please tell me.
Yes, the topic which you have given in the lecture. Where to get these notes regarding some notes through website? Is there any website available?
I couldn't get your
We
question,
can't get you.
please.
Please, आप हिंदी में भी अपना प्रश्न पूछ सकते हैं if you have any problem.
Would you please ask your question again?
Please repeat your question. The caller got disconnected. He was something asking about the lecture and the designing.
No, he was probably talking about can we get notes. I believe, if I am not wrong, if I could get him right, I believe he was talking about notes. So I don't know if he may call us again. We are not sure about his questions. Anyway, we will continue with the topic. So basically, this particular ratio we were talking about is to know that how well a company is doing and how much liquid a company is to pay its interest charges. So higher the value of this ratio is, better it is for the company, right? So for Norton Corporation, this value is coming out 11.5 times, so which is not bad. Anything more than 8 times, 9 times, 10 times is considered to be good. How to interpret this ratio? It means this Norton Corporation has 11.5 times profits available to meet its interest obligation, which is of 7,300 only, right? And the profits are 84,000 after meeting earnings before interest charges and plus income tax. So company has $84,000 of profits. So company is in a very good condition, with a good liquid condition, and for short term investors and for long term investors both, this is a very good news actually, for if the company has such a big value. Now the next ratio is there, which is known as debt to equity ratio or debt equity ratio. This ratio has been used to know the long term solvency of the ratios. As I said, we have different categories of ratios, and this particular ratio is used to know the how solvent a company is in long term.
Sorry to interrupt you once again,
Please.
ma'am. There is another caller from Rajasthan.
Please.
Hello.
Hello, ma'am.
Hello, yes, please ask your question, and please, it's our humble request to you, please ask clearly and loudly. Yes.
हाँ, yes, ma'am. मेरा क्वेश्चन ये है कि अपने जो इक्विटी शेयर होल्डर और इक्विटी शेयर फंड में क्या डिफरेंस है, अपने के इक्विटी शेयर कैपिटल क्या क्या इंक्लूड करेंगे?
Can I repeat this
We
question?
want to ask the difference between the equity shareholder and the
Equity shareholder funds. Is that the question? Difference between equity shareholders and equity shareholders fund. Is that the question you are talking?
नहीं मैम, इक्विटी शेयर होल्डर फंड और इक्विटी शेयर कैपिटल में क्या हो गया, और इक्विटी शेयर होल्डर फंड है उसमें क्या?
Equity share capital, right?
Yes, funds and capital.
Okay, I got it. See, equity share capital is the value of the capital which we multiply the number of shares which are outstanding with the price of per share. That is the equity share capital, right? So I hope you could get the price per share multiplied by the number outstanding of equity shares for the company. But equity shareholders fund comprises something more than this, which comprises equity share capital plus retained earnings. Retained earnings means those earnings which have been retained from the past years, the earnings which have not been paid to shareholders so far, right, which is there with the company. So equity share fund means equity share capital plus retained earnings and anything which is in the form of share premium. If company has issued shares on premium in the past, and that we are keeping it in a different fund as share premium fund or an account, so equity share fund will comprises these things: share capital plus retained earnings plus any premium account, any share premium which is there, right? So this is what equity shareholders fund. for certain books or certain accountants do consider to adjust fictitious assets out of it. We prefer to deduct fictitious assets from it and get the value equity shareholders fund, right?
Ma'am, I hope our caller might have got his answer very well.
Thank
but
you.
now we have very less time left, and I hope we could conclude this very lecture in our previous sessions also, which we are going to conclude or carry out in future months.
Yeah.
And we are going to study more about this very topic and various aspects of it. Thank you so very much for being with us in this EduSet lecture of ours,
Thank
and
you.
hope to meet you again with all our viewers who watch us continuously.
Thank you.
Thank you so very much.
Thank you.